This is the best financial advice I've ever received. I heard it when I was 20 years old, and it completely changed the way how I thought about money. A salary alone almost never makes people wealthy. Assets do. And most people never learn the difference because investing feels confusing. Stocks, crypto, real estate, index funds, ETFs, and somewhere on Instagram there's a 22-year-old telling you he makes 50K a month trading from Bali. So you hesitate. And while you hesitate, inflation quietly taxes your saving every single year. In this video, I'm going to show you how to fix that. My name is Serge Kaps. I've built and scaled multiple 7- and 8-figure businesses. Today, I run my own family office where I invest in businesses, real estate, and financial markets. I've made money and I've lost hundreds of thousands on deals I was sure about. That's what taught me everything I'm going to show you. Not a financial advisor, not financial advice, just someone who's figured this out the hard way. Okay, let's get into it. In this video, I'll show you 3 things. First, why money sitting in the bank account is riskier than most people realize. Second, how normal people build wealth using extremely simple investments. And third, the framework wealthy families actually use to structure their capital. So here's the simplest way I can put it. Money that sits still goes backwards. Not dramatically, not overnight, but quietly every year. Inflation eats away at what your money can actually buy. Here's a simple example. Netflix in 2014 cost $8 a month. Today, it's $23, almost 3 times more in 10 years. Your salary probably didn't triple, but if you had invested the difference every month, it would have grown significantly. Let's say you've got 10K sitting in a bank account today. In 10 years, assuming average inflation, that 10K will buy you roughly what $7,500 buys you right now. You didn't spend anything. You didn't lose anything on paper, but in real terms, you got poorer. Now, how does money actually grow? There are only 2 ways an asset makes you money. Either it pays you while you hold it, or it becomes worth more over time. Take a rental property. You buy it, a tenant pays you every month, that's income. And 5 years later, the property is worth more than you paid. That's appreciation. 2 streams, same asset. So now you understand why you need to invest. Next question, what do you actually buy? Let's talk about stocks. When you buy a stock, you're buying a tiny piece of a real business. Buy Apple stock. You literally own a fraction of Apple. There are 2 ways that makes you money. So either the company grows, the stock price goes up, and you sell for more than you paid, or the company shares its profits with you directly every few months. And that's called a dividend. Think of it like rental income, except instead of a property, you own a piece of a business. Now here's where most people go wrong. They think investing means finding the next Apple before it becomes Apple, picking the winners. Trying to pick stocks as a beginner is like trying to win a Formula 1 race on your first driving lesson. The car is real, the track is real, but you have no idea what you're doing, and the consequences are expensive. Remember BlackBerry? In 2008, everyone thought it was the future of smartphones. 1 share cost $144. Today, that same share is worth around $4. Nobody saw it coming. Then the iPhone arrived, and it was all over for BlackBerry. And here's the uncomfortable truth. Even if you spend your evenings reading company reports and analyzing balance sheets, it's incredibly hard to know which companies will win long term. Professional analysts do this full time and still get it wrong constantly. I had another friend who in 2017 was convinced he found the next Tesla, an electric car company that looked unstoppable. He put $180K in. Within a year, it was down 87%. While he was sitting there analyzing reports and hoping for recovery, the S&P 500 went up 38% in the same period. He would have done better doing absolutely nothing. So instead of picking stocks, you buy the whole market. That's what an index fund is. The S&P 500 is the 500 biggest companies in America. Apple, Google, Amazon, Microsoft, all of them in one investment. You put in 1K, that money automatically spreads across all 500 companies. You own a tiny piece of all of them. Warren Buffett had said it for decades, never bet against America. And the S&P 500 is the purest way to bet on America. But here's something most people don't know. More than half the revenue of S&P 500 companies come from outside the United States. So even if America specifically hits a rough patch, you're still exposed to global growth. You're not just buying America, you're buying the world's best companies which happen to be headquartered in America. Now you might be thinking, why buy all 500? Why not just buy the best ones? Apple, Google, Nvidia, for example, Microsoft, the Magnificent Seven. They've dominated the market for years. Just go all in on those. Here's the problem. Look at what dominated the S&P 500 in the 1980s. General Electric, Exxon, Walmart. In the 1960s, Kodak, American Express, Polaroid. Everyone assumed they would keep growing. Kodak fell over 90%. Nobody predicted smartphones would make film cameras irrelevant. There is absolutely no guarantee that today's winners will still be leading a decade from now. Nobody knows. And that's exactly why you buy all 500 companies. Here's why this structure is so powerful. And this is an idea from Nassim Taleb. Markets will always have black swans, crashes, pandemics, wars, things nobody saw coming. And if you're betting on one single stock, just one bad quarter, one scandal, one wrong CEO, and you're done. But the S&P 500 is built differently. When a weak company company fails, a stronger one takes its place. The system is designed to absorb shocks and keep going. Taleb would call that anti-fragile. That's not luck, that's structure. In 2007, Warren Buffett made a bet, $1 million. He said a simple S&P 500 index fund would be the best hedge fund managers in the world over 10 years. Professionals, full-time. Teams of analysts, access to information you and I will never see. By 2017, the hedge fund had returned that million into 1.2 million. Buffett's index fund turned it into 1.8 million. The best minds of Wall Street, beaten by doing basically nothing. The hedge fund manager conceded early. He didn't even wait for the end. And this wasn't a one-off. S&P Global tracked professional fund managers over 20 years, and more than 90% failed to beat the index. Day traders are even worse. Around 70 to 80% lose money long-term. Not because they're stupid, just because it's an incredibly hard game to win consistently. Now here's the detail that really kills me. Buffett himself, the greatest investor in history, in his will he wrote, "Put 90% of my wife's money in a low-cost S&P 500 index fund, not in Berkshire, not in the stocks he picks, in an index fund." And if you look at Berkshire's performance over the last 20 years, it barely beats the S&P 500. The greatest investor of all time barely beats the index. That means you just don't have to play it. Einstein reportedly called compound interest the eighth wonder of the world. Here's why. Let's say you invest $500 a month starting today. The S&P 500 has returned around 10% per year on average historically. So after 10 years, you've put in 60K, but your portfolio is worth around 102K. But keep going. After 20 years, you've put in 120K, your portfolio is worth around 380K. After 30 years, you've put in 180K and your portfolio is worth over $1.1 million. You didn't do anything different, same $500 a month, the only variable was time. 30 years of doing nothing and you're a millionaire. So here's a number that puts everything in perspective. 10K invested in the S&P 500 in 1970 would be worth over 3.4 million today. Not because of luck, because of 55 years of compounding. That's it. Here's a number that will change how you think about this. Warren Buffett, the greatest investor in history, made nearly 98% of his entire net worth after the age of 60. Not because he suddenly got smarter, because compound interest had been running for decades. The machine just kept accelerating. The single biggest mistake people make is starting late. Not investing wrong, just starting late. Every year you wait costs you more than you think. Now a question people always ask, when do I buy? Should I wait for the market to drop? Should I try to time it? The answer is no. And here's the strategy that removes that question entirely. It's called dollar cost averaging. So you pick a fixed amount, say $200 a month, and you invest it automatically every single month. No matter what the market is doing. Up, down, sideways, you buy. When the market is up, your 200 buys you fewer share. When the market is down, your 200 buys you more. Over time, it averages out and you stop thinking about timing entirely. One more thing. Every December, increase your monthly contribution by just 1%. That's it. One decision, once a year, the math is staggering. Two people, same salary, same returns. One keeps contributions flat, the other increases by 1% every year until they hit 15%. The difference at retirement, the second person ends up with roughly 2.5 times more. Just from one tiny annual decision. Here's a stat that stops most people cold. If you miss just the 10 best days in the market over the last 30 years, your total returns would be cut in half. 10 days out of 10,000. The people who try to time the market almost always miss those days because they're sitting on the sidelines waiting for the perfect moment. One more reason not to trade in and out. In most countries, if you hold an investment for more than 1 year, you pay significantly less tax on your gains than if you sell within a year. Long-term investors don't just make more money, they keep more of it. Set it up once, forget about it, and let it run. Okay, so practically, how do you actually do this? You need a brokerage account. Think of it as a bank account but for investment. In the US, use Robinhood or Fidelity. In Europe, Trading 212 or DeGiro. Both free, both regulated, both take about 5 minutes to set up. If you want one platform that works almost anywhere in the world, that's Interactive Brokers. Slightly less pretty, but very serious. One thing to check before you pick a platform or fund: fees. An index ETF charges practically nothing, less than 0.1% per year. An actively managed fund charges 1 to 2%. But that sounds like nothing. But over 30 years, the difference can eat up to 30% of your final portfolio. Always check the expense ratio before you buy. And once you're in, search for VOO or SPY if you're in the US. In Europe, search for VUSA or SXR8. These are ETFs that track the S&P 500 direct. Pick one, hit buy, choose your amount, and done. That's it. You now own a piece of the 500 biggest companies in America. One small but important detail. When choosing your ETF, look for the word accumulation in their name rather than distribution. Accumulation means dividends are automatically reinvested back into the fund. Distribution pays them out to your account. For long-term investors, accumulation is almost always better. Let's think about faster compounding. One more thing, if you're not ready to invest your money yet, that's fine. Trading 212 has a practice mode. Real market data, fake money. And you can get familiar with how everything works before you put in a single euro or a dollar. And when you're ready, one button switches you to real money. By the way, I put together a free one-page checklist. Exact platforms, exact ETF tickers, exact amounts to start with, depending on where you live. US, Europe, global, everything you need to make your first investment this week. Link is in the description, takes 30 seconds to get. Okay, so now you know what to buy. But here's what actually stops most people from ever doing it. The fear. What if I invest my money and the market crashes? What if I lose everything? Let's talk about that, because it's a real fear and it deserves a real answer. Here's what actually happens in a crash. Let's say you invested 10K right before the 2008 financial crashes, one of the worst crashes in modern history. The market dropped around 50%. So your 10K is now worth 5K. That feels terrible. And if you panic and sell, you've locked in that loss. Your money is gone. But if you just did nothing, by 2013, you were back to where you started. And by 2024, that $10,000 would be worth around 70K. The only thing you had to do was not panic. The market crash doesn't destroy your wealth. Panic does. Think about what the S&P 500 has already survived. Black Monday 1987, the dot-com crash, September 11th, the 2008 financial crisis, COVID. Every single time people said this is the end. Every single time the market recovered and went on to set new all-time highs. That's not luck. That's the nature of a system built on human productivity and innovation. And here's another way to think about it. What are the chances that all 500 of the biggest companies in America go to zero overnight? That's basically zero. Because every single day, thousands of people are showing up to work at Apple, at Google, at Microsoft. They're building things, shipping things, adding value. The human effort doesn't disappear, it compounds. If all 500 companies somehow drop to zero, we'd have much bigger problems than our portfolios, believe me. And here's the thing. Fidelity, one of the largest investment firms in the world, looked at which of their customer accounts performed best over time. You know what they found? The best performing accounts belonged to people who had forgotten they had an account, or people who had died. Literally, dead investors outperformed active ones because they never sold. By the way, if you're watching this and there's something that's been holding you back from investing, drop it in the comments below. I read them and it genuinely helps me make better videos. And if this is making sense so far, hit that like button. It genuinely helps more people find this video. Look at basically any wealthy person and you'll find the same thing. They own assets, stocks, businesses, real estate, things that grow while they sleep. A salary alone almost never gets you there. There's only so many hours you can sell. Most people will never become wealthy, not because they don't earn enough, but because they never buy assets. A salary pays your bills, assets build your wealth. There's only so many hours you can sell. That's the whole game. Own things. So how much money do you actually need to start? Way less than you think. Most platforms let you begin with as little as $5 or $10. The amount matters way less than the habit. Start small, start now, and let compounding do what it does. Wealth is rarely built with one big decision. It's built with thousands of small decisions repeated over time. One more thing on losing money. Trading. Actively buying and selling stocks, trying to time the market. Less than 1% of traders make money consistently over the long term. Not because they're dumb, because it's structurally almost impossible to win. Don't play. Okay, foundation is set. Now before part 4, something most investing videos skip entirely. What to avoid. Before I show you how to structure my own capital, I need to talk about something most investing videos skip. What not to do. If a friend asks you to invest in their business, pause. I get it. Maybe you've known this person since school. You trust them. They seem to be onto something, and it feels wrong to say no. But in 95% of cases, investing in a friend is just a terrible idea. It rarely works out. And when it doesn't, you don't just lose money, you lose the friendship too. The kindest thing you can do for both of you is keep the two things separate. I had a friend who did exactly this. Smart guy. Came to me excited about a startup. His friend's company. Guaranteed to work. He invested $340K. 14 months later, the company was gone. He lost the money and he lost the friendship. That story stuck with me. The first law of money isn't how do I grow it, it's how do I not lose it. Same goes for startups. Venture investing is a professional discipline. The best funds in the world make 30 bets. Only one pays off. Research by Correlation Ventures found that 64% of venture deals don't even return their original capital, and the average venture fund after fees delivers roughly the same return as the plain S&P 500 index fund, except that your money is locked up for 10 years, and the risk is in a completely different league. Unless you have access to the top 25% of funds, you're just paying extra for the risk. If someone promises you returns above 20% per year, that's not an opportunity. That's a warning sign. Pyramids, schemes, anything where someone promises fast money, forget it. From personal experience, when promised returns go up sharply, risk goes up even faster. Here's the thing nobody tells you. The first job of money is not to grow, it's to survive. Most people learn this the expensive way. Here's what all these traps have in common. Crypto schemes, hot startups, day trading. They all require you to predict the future, to know what's going up, to know when. Most people think investing is about predicting the future, and it isn't. The best investors in the world don't try to predict the future. They build systems that work across many possible futures. That's the real game, and that's exactly what I'm about to show you. Which brings me to how I actually think about this. There's a structure the wealthiest families in the world use, and the first principle of the structure isn't how do I make the most money, it's how do I make sure I don't lose what I have. Protection first, growth second. That's the foundation. So everything we've covered so far, index funds, S&P 500, not panicking, that's layer one, and it works. But I want to show you how I actually structure capital across all three layers, because it goes further than just buying an index fund and waiting. The largest family offices in the world, the structures that manage wealth for billionaire families, they don't just put everything in the S&P 500. They build across three layers. First layer, core capital, index funds, broad market exposure. This is your foundation. It compounds quietly in the background and you never touch it. Second layer, income, assets that throw off cash while you hold them. Rental properties, dividend stocks, things that pay you every month whether you're working or not. And third layer, high conviction bets. This is where you take concentrated risk. A business you're building, a sector you understand deeply. Crypto if you know what you're doing. The potential returns here are in a completely different league, but so is the risk. The key insight is this. These three layers serve different purposes. Core capital protects you, income funds your life, and high conviction bets are how real wealth gets built. When I exited my second business, I had two choices. Put everything into one big idea or build a system. I chose the system, and that decision, more than any single investment, is what changed everything. Here's roughly how I allocate my own capital. About a third in core capital, index funds, S&P 500, it just sits there and compounds. About a third in income generating assets, mostly real estate, things that throw off cash, and about a third in high conviction bets, private deals, crypto, concentrated positions. Now if you're just starting out, forget the second and third layer for now. Seriously, just focus on layer one. Get that foundation built first. The other layers will make sense later, and I'll cover them in detail in future videos. But for now, the most important thing is just to start. Layer 1, index fund, whatever amount you can afford this week. Because the biggest mistake isn't picking the wrong stock, it's waiting until you feel ready. You never fully feel ready, you just start. If you remember just one thing from this video, remember this. Wealth is rarely built by chasing opportunities. It's built by owning assets and giving them time. That's the real game. Investing isn't about being smart, it's about having a system. And once you understand that, everything changes. If this changed how you think about money, hit the like button right now and subscribe. Because next, I'm going to show you what the wealthiest families on earth actually put in their portfolios. Not theory, the real framework. You don't want to miss it.